Hello, Business 330 students. This is Mr. Hassey. It's our week 3 weekend update video for this Saturday. A couple things going on this week. The assignment number 1 grades have been posted to your Blackboard. Please review. And the solutions to assignment 1 are now posted in the assignment section, assignment file folder section of Blackboard. What I do is I upload your corrected or my corrections to your work, to Blackboard, to your grade center. You can download them and take a look at it. Please make sure you understand and take a look at your grade center for the grades that are posted to your account. Some of you have some no grades in some work thus far in our course. Make sure you understand that. If you have any questions or concerns, please let me know as soon as possible. If you want to have any answers or want to check and make sure you get caught up with any of your work that is still not posted. Also today, we're going to take a look at the final 2 problems of review for Chapter 5, problem 19 and 38 at the end of Chapter 5 from your textbook. And you have assignment number 2, which is about Chapter 5, is due this Sunday at midnight. Extensions are available if you need extra time. So there we are heading into this 3rd weekend, and let's take a look at assignment number 1 solutions that have been posted to Blackboard. The purpose of assignment number 1 was to highlight chapters 1 through 4, which is basically an introduction to business finance, the definition of finance, the understanding of financial statements, the understanding of the role of financial managers they play in corporations. So you can get an idea of how that is and express that to me as an assessed work of assignment number 1. So the first few questions are pretty self-explanatory. If you go to your graded posted work that I've done, I either highlight in green or yellow areas that you missed, or also look for the red typing of letting you know how many points were deducted for that work. And if you have any questions on that, please feel free to send me an email or get in contact with me. Also, remember, not too many people have been participating in this, but our Thursday night student hours from 6 to 8, that's a good time to come on and talk to me about grades or any other questions you might have about the course. What are the goals of financial management? Well, basically, it's to maximize shareholder value. What are the functions of the financial markets? To provide the ability to transfer and produce cash over a variety of different markets, transfer risk, provide liquidity, and allow for greater diversification in investing. Financial markets help channel savings to corporate investment, matching borrowers and lenders. What are the 2 major decisions made by financial managers? 1, the investment or capital budgeting, and 2, how to finance that investment or capital budgeting. So investment and financing decision are the 2 major decisions of a financial manager. Some series of multiple choice questions. Which of the following groups is least likely to be considered a stakeholder of the firm? Naturally, your competition would not be a stakeholder in a firm. That's the correct answer for that one. The cost of capital, all these 4 are fairly reasonable answers, but the best answer for the cost of capital is for risky investments is normally higher than the firm's borrowing rate. All the other 3 are answers, but not as specific as that one. If you picked those other ones, you got 1, 2, or 3 points off of the 5. Question 6, which of the following information is not provided by the financial markets? Microsoft earnings. Microsoft earnings provides that information to the financial markets. The other ones, the price of gold, borrowing costs, interest rates, and the cost of wiring are all based on supply and demand of the marketplace and set by the financial markets. So the correct answer there is C. Question number 7. I wanted you to find 3 numbers. I wanted you to find the operating profit or earnings before interest and taxes, which is $160,000. I wanted you to find the net income of the company, which is $78,000. And I wanted you to find the cash flow from operations, $98,000. Those are the 3 correct answers. Naturally, you show your work, but also when you're given the information of the problem, the key assessment of this problem was you to determine which of these numbers given to you from the company's financials you use in finding these 3 numbers. Sales, naturally, 500,000. Cash dividends. Cash dividends is a cash flow from financing. And so that has nothing to do with operating income, net income, or cash flow from operations. Dividends is paid after the bottom line is assessed, and it's cash flow from financing. So cash dividends is not included in this. Cost of goods sold, naturally, it's an expense. Administrative expenses, depreciation expense, yes. Interest expense, 40,000. Interest expense comes after the operating profits, EBIT. $10,000 purchase of productive equipment. That has nothing to do with operating expenses or income. It's cash flow from investing in additional assets of the business. So that has nothing to do with this problem. So in addition to cash dividends, purchase of productive equipment, $10,000 is not part of this problem. No changes in working capital, which is very important to determine cash flows from operations. And the tax rate of this company is 35%. So if I take the sales minus the 3 expenses given to us, I end up with an operating profit of the first answer, $160,000. From that, I subtract out the interest expense of $40,000, and I get an earnings before taxes of $120,000, of which I take 35% of that $120,000 to get $42,000, which is my income taxes, and thus I now come up with a $78,000 net income. Remember, cash flow from operations is made up of net income, depreciation, and changes in working capital. Accounts receivable, inventory, accounts payable, and accruals. So in this case, with no changes in working capital, cash flow from operations is definitely net income of $78,000 plus depreciation of $20,000 to get a cash flow from operations of $98,000. Thus, question number 7. A great problem to understand financial information given to you a little bit differently, as is the case in many financial managerial situations. Last 3 or 4 everybody did very well. What are the standard measures of firms' leverage, liquidity, efficiency, and profitability? This is taken from chapter 4. These are all defined in that chapters. What is the significance of these measures? And there's a good explanation in my solutions. Define a profit loss statement. What does it tell you about a firm, who uses it, and why is it important? Some students were taken off points in here because you only answered half the problem. Remember, read each question carefully and make sure you answer the problem fully. Question 10 was to take the last 3 fiscal years of a company selected from your portfolio. Many selected Tesla, many selected Apple. How have they changed? Remember, the earnings per share is given to you by the company, or sometimes you can determine it as a net income divided by the number of shares of stock outstanding. And thus, I was looking for those 3 numbers from the last 3 fiscal years, 12 months. Question 11, again from chapter 4, is to go back 2 fiscal years and find the current ratio, the debt ratio, and the profit margin in those 2 years of your companies. And again, some people missed this one, a brief comment for each on what they represent as analysis for the company. Current ratio is an analysis of liquidity. Debt ratio is an analysis of leverage. How much debt is used to acquire assets. Profit margin is the relationship of net income to the sales of the company. So those were the definitions of chapters 1 through 4 in our assignment number 1. You do have assignment number 2 this Sunday, where I'm asking you to do some calculations about the time value of money. And also I want you to update your portfolio as of Friday, September 8th, and to find an additional bit of information, the beta of each of the company stocks in your portfolio in that specific column. You do not have to locate dividends. You'll be locating the dividends of the company during the update of your portfolio for the final examination. Not until then do you need to worry about dividends. And then a couple of key things is tell me how they have changed your portfolio from way back in August 25th to today. How has it changed in dollars and percent from the original buy? And how has the Dow, the S&P 500, and the NASDAQ changed from the original start date? And that will give you the answer of did you better the markets? I provided a sample spreadsheet file in Blackboard for you to follow along how to do that. So make sure you post that separate spreadsheet file as the second file you're indicating for assignment number 2. And that'll lead us into next week's week 4, where we talk about bonds and stocks. So there's 2 problems that highlight our final work and final notes about chapter 5, and that's problem 19 and 38 in your Blackboard or in your textbook. And I have updated with an additional tab in your review spreadsheet file for my lecture notes, and that is in week 3 lecture notes file folder in Blackboard as well. The first question is, with a 2-year discount factor of 0.92, what is the present value of $1 to be received in year 2? And what is the present value of $2,000? Well, let's take a look at that in our spreadsheet. Well, remember, they tell us that a discount factor is your discount number or rate is equal to 0.92. Well, if I have $1 and I multiply it times 0.92, oops, I get 0.92. In other words, the present value of a discount of 8% over 2 periods is 92. So a dollar goes from $1 to 92 cents over 8 years. Well, if I take that discount factor and multiply $2,000 times 0.92, that's the discount factor, I get $1,840. Which makes sense. That's the current present value over 2 years discounted at that period over that period of time. The discount factor is another way of looking at a calculation. Remember last week we did it this way. Function, present value, we put our discount factor at So the discount way is another way of doing the problem by just taking 0.92. Now, really, the present value of a dollar is this. Function, present value. Here, remember the discount factor given the problem is 0.92 over 2 years. That's 8% over 2 years. That's really 4%. So if I put in 4% and do it over 2 periods, and the future value is $1, I get roughly 92 cents. Okay, so that's how that comes out. So in other words, the discount factor, so really the interest rate in this problem is not 8%, it's actually 4%. 4% over 2 periods, thus 8%. So just another way of looking at it. But if you calculate your present value and future value using your spreadsheet, it makes it a lot easier to calculate that information. So question 38 is a common question if any of you play the lottery. Let's say I win a $40 million prize in the lottery after taxes. And I take that money and I have two options. I can get a lump sum payment today, or I can get that $40 million given to me over 20 years at $2 million a year. So I can get the $2 million every year, but I got to get it over 20 years. Or I can get a lump sum payment now with the interest rate that the lotto folks use is 8% or the discount rate. Well, what would that be? What would be my lump sum payment? That's called an annuity due. In other words, you're giving up a series of payments over time to a lump sum payment today. Let's see what that looked like using our spreadsheet. So if I take that calculation, present value, and now type in my discount rate given as 8%, it's over 20 periods to get that paid off, and they're paying me, I'm giving up the $2 million a year for 20 years. What would be the lump sum payment? 19,636,294.81, or roughly $19.64 million. So instead of getting $2 million every year for 20 years, I can get one lump payment now at $19.64 million. And a lot of people choose that when they get the lottery because now they get the big chunk of money and now they can use value and invest it or do what they want with it. And hopefully that grows in value quicker than the interest rate that they were given, the 8%. Now that's a stretch because 8% is a very high rate. Most lotteries use 4 or 5%. But that's how that works with lump sum payments in lieu of a payment over a variety of years. And that's why that's called an annuity due. The annuity is what you're giving up, the $2 million annual payments over the course of 20 years. And the due is what's that worth today? 19.64 million. So there's a variety of different things we've seen in Chapter 5. We've seen the future value of money, a one lump sum payment in the future. What is it going to be? We've seen the present value of money, one lump sum received in the future. What is its value today? We've seen the cash flow in the future. What is its present value today? And that we've seen amortization, how to determine a payment structure of interest and principal over time. And now finally, going the other way, if we receive money in the future in lieu and getting equal payments over time, forget the equal payments. What would that be in a lump sum payment? That's called the present value of an annuity due. And those are the key components that are discussed about the time value of money, of which we'll be using over and over again if in the remaining 5 weeks of our course. So this concludes our weekend update video for week 3, chapter 5. Please review your assignment 1 results. Please don't forget assignment 2 is due on Sunday, and then we'll have our new week 4 video posted on Monday where we talk about stocks and bonds. Any questions or concerns, you can email me or post to the discussion forum or set up a Zoom meeting with me at your convenience. Have a great rest of the weekend, everybody, and we'll see you again on Monday. Adios.